Hi everyone, so today Dom and I are going to be doing another stock analysis video for a new company called ACM Research. And Dom is going to do a company analysis and then he's going to get into Q3 of 2025, the earnings report. So Dom, whenever you're ready.
Alrighty, you see my screen?
Yeah, perfect.
Cool. So just a quick background on this company, AMC Research Inc. So they were founded in 1998 in Silicon Valley. Oh, I can't highlight where I'm reading, but I'm in the middle of this page.
Okay.
So they were founded in 1998 by Dr. David Wang. He initially made it a stress-free copper polishing technology, but it didn't really take off too well. So then he shifted it to advanced wafer cleaning and established it as a principal operating subsidiary of ACM Research of Shanghai Incorporated in China. And then this kind of helped them carve out more of a niche developing proprietary technology like alternated phase shift for superior defect removal on silicon wafers. And then more of today, they're more of a broader portfolio that they have. So it says that they have a multi-product portfolio essential for fabricating foundry, logic, and memory chips. It says their key products include single wafer, wet cleaning equipment, electroplating, furnace tools, and advanced packaging solutions. So they've kind of branched out into mostly China, Southeast Asia, with their chips, and then other like technology part of their portfolio. That's kind of like a little bit about them as themselves. Getting into Q3 2023, or excuse me, 2025, we do have kind of a mixed bag of results. So in this article, it states that revenue was at 269.16 million, which is up 32% year over year, which is above the consensus. Consensus was at 251.7 million. They said gross margin did fall to 42% due to product mix and inventory provisions. Non-GAAP diluted earnings per share is at 36 cents versus consensus at 53. While GAAP diluted earnings per share was 52 cents. They also had to narrow their guidance. So it says that management narrowed the fiscal year 2025 revenue guidance to 875 million to 925 million. It was previously a little bit wider. It was started at the base at 850 million and the ceiling was at 950. So they kind of contracted a little bit to narrow it down. So not like the worst, but obviously lowering a ceiling is never something people want to hear when they're looking for revenue updates. And then they said that this contraction was cited due to trade policy, customer spending scenarios, supply chain constraints, and timing of first tool acceptances, and effective tax rates. I guess tax rates went to 7 to 8% from originally 10 to 15% earlier in the year. They did say total shipments were up 263.1 million, which is 7%, or excuse me, 0.7% year over year. Their CFO did have um, expectations for Q4 shipments down quarter over quarter, and then full year shipments are down year over year on customer pushouts and part shortages. Net cash ended at around 811 million with liquidity, cash, restricted cash, and time deposits at 1.10 billion. So overall, they were hitting on some targets, some things like not so much. Overall, I would say, like I said before, a bit of a mixed bag.
Mm-hmm.
Not too much where you can kind of swing it one way or the other. So I kind of let Matt take over and we'll go more deeper dive into the financials of the company. We can kind of see how that's playing out for him.
Okay. All right. Thank you, Dom. I appreciate it. All right. So, like Dom was saying, it is a mixed bag. And you know what? Surprisingly, we're going to have a mixed bag a little bit on the DCF or the free cash flow growth here. The last 3 years were excellent. They started out negative. They were negative 123 million. Wow. And then they became all the way negative 11 million. And now they're saying that in the next 3 years, it's going to be positive 42 million, which again is still remarkable to see because it's still going to be positive. It's going to be positive probably next year. And in 3 years, it's going to be positive 42 million. So still really good upside with that. The financial health of the company is also incredible as well. Minimal debt, a lot of cash, a lot of equity. Really can't complain. There's nothing wrong on this photo at all, which is great. We have a DCF that still says that is undervalued by 73%. Also really good. They've had a tremendous rally. It rallied year to date 150, 160%. I think it was like 156 or something like that. It's an insane rally so far this year. And Wall Street forecast is going to have it that it's overvalued by 54%. I wouldn't. I don't think it's overvalued. If anything, if you took the median between the two, or the average between the two, the mean between the two, I think it's about probably the same. Maybe it's fairly valued with a little bit of undervalued, because if you we check Tipranks, Tipranks is going to say that it is a strong buy still. However, keep in mind that the upside is only going to be about like 8%. Let me reload it one more time. Yeah, it'd be about like 8-9%. Still a strong buy, but I think I would probably wait for some kind of dip for the company before I would purchase any shares, because they had such a big rally this year. But I think it looks like a semi decent company, just maybe one off bad quarter. Dom, is there any closing thoughts?
No, I definitely agree. Looks good. I'd say, like you said, that the one bad quarter does make it paint a weird picture,
Yeah.
but overall, definitely something to keep on the radar.
Yeah. Okay. All right. Thank you, Dom. Thank you, everyone.
Thank you.